My name is Mickey Quinones. I'm the Dean of the Robbins School of Business here at the University of Richmond. We want to welcome you all to our panel on the financial markets. This is panel take 2. We had a similar panel, in fact, the exact panel in May, right, as we kind of the reality of the pandemic and the economic ramifications of that were coming to fruition. And we wanted to have a conversation about how it was that as we were enduring some lockdowns and really kind of a stoppage of a lot of economic activity, our financial markets, after an initial dip, kind of recovered. So we had some discussion about what could be driving that and what was going on, what we could expect. So tonight is a follow-up to that. We're obviously now farther along in the health crisis and economic crisis, and we're the economic picture. I mean, I'm curious to hear whether the panel feel this is a proper characterization, but I would say it still remains murky, at least for a neophyte like me. So we felt it was timely to bring back the panel, get the band back together, if you will, especially after an election, and see what they think is going on, what they expect to happen, what they would like to happen. So we're really looking forward to a great conversation tonight. For those of you in the audience, make sure you make use of your Q&A function. We will be taking questions from the audience as we go along. Obviously have some prepared discussion points that we want to hit. The most obvious one is the impact of the election on the financial markets. And we saw some things happening today. But please make sure you put in your own questions, because I know you have some things you want to talk about. We're very lucky. We're joined today by 4 Robbins School alumni and current and former members of our school's Executive Advisory Council. So we got a panel full of spiders, which is the best panel you can have. In our Executive Advisory Council is a group of highly committed and influential business leaders from around the world who give advice to the school and advocate on our behalf. And we are just always grateful for that support. The spider support is outstanding. So let me introduce the panel. First, we have Katie Stockton. Katie, I don't know if you want to wave so people know who you are. There you are. Katie is founder and managing partner of Fairlead Strategies. Prior to forming Fairlead Strategies, Katie served as chief technical strategist for New York City-based broker-dealer BTIG for 4 years and was chief market technician at Stamford, Connecticut-based MKM Partners for 9 years. She also worked for technical strategy teams at Morgan Stanley and Witt Soundview. Katie received her Chartered Market Technician designation in 2001 and later served as vice president of the CMT Association from 2012 to 2016. In 2017 and 19, she was honored by the technical analyst for her work, and she was a member of the Endowment Investment Committee for Christchurch, Greenwich. And she frequently shares her views on CNBC, Bloomberg TV, and often speaks at industry events and conferences. So you didn't have to tune into cable TV to watch Katie. So thank you, Katie, for sharing your time with us. We also have Kathleen Hughes. Kathleen, joining us from London. I appreciate you taking the time, late, not too late, about 9 something, so hopefully after dinner. She's Global Head of Liquidity Solutions Client Business in Goldman Sachs Asset Management. She serves as co-sponsor of the Consumer and Investment Management Division Women's Network in Europe, Middle East, and Africa. She's co-sponsor of the EMEA Veterans Network and is a member of the Sustainable Finance Steering Group. Kathleen joined Goldman Sachs as a managing director in 2010 and was named partner in 2016. Kathleen was named Investment Woman of the Year, Large Firms by Investment Week in 2018 and 19, and one of the 100 most influential people in finance by Treasury and Risk Magazine in 2011. And she's also a member of the Board of Trustees, so she is my boss. So thank you, Kathleen, for being here. Michael Kelter. Michael, want to say hello? Thank you. Michael is a managing director at First Manhattan Company, a 54-year-old asset management firm with over $15 billion of assets under management. He works closely with Sandy Goetzman, the firm's founder and longstanding member of Berkshire Hathaway's board of directors. Prior to joining First Manhattan, Michael spent 6 years at Goldman Sachs in its Global Investment Research Division. Previously, Michael spent 5 years in operating roles within the consumer product industry. And Michael holds an MBA, in addition to being a spider, obviously, holds an MBA from NYU's Stern School, and he serves on the board of directors and as treasurer of the New York Milk Bank, a nonprofit organization. And finally, David Lyons. David serves as managing director and chief operating officer of Lau Brockenbrough and Company and is a member of the firm's executive committee. He is responsible for the firm's operations and assists with institutional advisory services. Prior to joining Lyle Brockenbrough, he was vice president of institutional marketing at T. Rowe Price Retirement Plan Services. In addition to his UR degree, David received an MBA from Johns Hopkins University. He's a member of the University of Richmond Alumni Association Board of Directors and currently serves as the board president. David is president and member of the board of directors of the Country Club of Virginia and is a former chair and current member of the VCU Massey Cancer Center Advisory Board. Past board affiliations include the MCV Foundation, Southern Benefits Education Network as president, CEBS, and the Virginia Squash Rackets Association. So I guess you're an avid squash player. All right, so as you can see, we have a great panel, and we're ready to have some discussions. And again, I invite all of you to put your questions up on the Q&A as we go along. All right, so here we go. We just had an election, and it's been called, at least by the media. So we have a Biden-Harris administration, and it's still unclear what the nature of the Senate. The House is pretty clear that it'll be a Democratic House, but potentially the Republicans will maintain control of the Senate. So that's part of the context. Today, we had a big announcement that Pfizer vaccine has shown to have a 90% efficacy. So that's also important. And then we saw the markets today rally, then got tempered a little bit. So the Dow went up nearly 3% to over 29,000. The NASDAQ went down 1.5%, S&P around 1.2%. All right, so that's what's going on. And please tell me if there's anything else you feel sets the context that we need to talk about. But let me just first get your overall reactions to what do the elections results mean for capital markets? What do you think is being priced in, and what are the anticipations that are being set?
Mickey, I'll start on that. I'm not a politician by any stretch. I'm a technical analyst, so I focus on markets as it pertains to price and trends and supply and demand for the securities, not the actual company's products. But what I will say is that the markets do tend to get very skittish when there's any kind of uncertainty. And indeed, we've had a lot of that over the recent weeks. And you can really see that in the major indices. Equities have been all over the map. It feels like every 2 weeks it's way up or way down. And I think that that's a reflection of the uncertainty that was built in ahead of the election. Now that we've got it somewhat past us, it appears that the market is welcoming of what it perceives as good news. And indeed, we've seen a very strong rally since the election. Even though the results weren't affirmative at the very beginning, there seemed to be a comfort level that now that event had passed. And then, of course, you get today's news from Pfizer, and that just exacerbated that rally, even despite today's close.
So you said good news. What is the market considering to be good news here?
Well, I think good news might just be the relief of that uncertainty. I just think it likes to have the complete information available. So I don't know that it's looking at, the Trump loss as a positive or a negative necessarily. Certain, like obviously some industries will benefit less or more than others. But I do think that it's seen sort of the split, the Senate issue as one thing that could be a positive. But more importantly, from my perspective, it's just that removal of that uncertain moment. It's kind of the, I guess we want to sell the rumor, buy the news type of thing.
Okay. What is being priced into the market? What is the market expecting going forward?
I'm happy to weigh in there. Mickey.
Yeah, please.
I think if you look at what we can assume, or if we take the assumption, which I think is where the market is, that we are looking at a split government. And again, this is all meant to be seen as votes get counted and we see how Georgia plays out. But if we assume that there will be a split government, the impacts there are things like, less regulatory risk for technology and pharma. And I think we saw that in prices last week, at the latter half of the week, as this was sort of starting to play out. I also think that means, less likelihood of tax increases, and a more muted fiscal stimulus. So we still see a fiscal stimulus happening, we think by the end of this year, but maybe more in the 1 trillion range as opposed to 2 trillion range that could have happened with a blue wave. And we think that's important for the US economy certainly the focus could be around small businesses and support there, which will be important. We also think, less likelihood of tax increases. I think I mentioned that, less big multi-trillion-dollar infrastructure spends or big climate-related projects. But I think on the climate front, Biden will be positive for things like the Paris Accord and other maybe ESG type initiatives that are within the power of executive orders. So that's some of the things that we're thinking about or potentially expecting as this plays out.
Okay.
Yeah, I think that, and I agree with all those things. I'd say, when we just got the Goldilocks scenario where you got Biden who won, who, whether you agree with his politics or not, should bring a level of stability, which, as Katie said, the market can't handle uncertainty. And so, well, you get the stability, but you don't get the big tax hikes. And, when it comes to the virus, not only did you just get news of a vaccine, you got one with 90% plus efficacy, which is a positive surprise and, may not have been the case. And so you got very good news on all important fronts. But to go back to your question, when you asked it, the thing that came straight to my mind when you said, what's the market expecting or pricing in? To me, I think the market is pricing in low interest rates for much longer period of time, and otherwise you would have a hard time justifying the multiples. And I don't mean just for stocks, high multiple stocks. I mean, whether it's muni bonds or investment grade corporate bonds, whether it's Microsoft or Apple or Amazon, whether it's any of these things, the market is pricing in low interest rates, and that kind of flows through to everything.
So I don't know if you can, this is kind of a naive question on my part, but and you may not be able to answer this, but what are the expectations from the market in terms of how long the virus and the pandemic will last? Can one kind of discern whether they feel this is a 1 year, 2 year? Because obviously we have some news with the vaccine. This is not it's not a final, like there's still there's more to this trial. And then there's a whole distribution challenge and everything else, right? So this is not like tomorrow we're going to wake up and all get vaccinated. So how long do you think the market is pricing in our kind of current situation? And are they even pricing in the possibility of further lockdowns or not? Or would that be considered and against their expectations? What do you think the market's expecting in terms of how long this will last?
It doesn't seem like it's pricing in much of anything right now in terms of downside with the major indices at or near all-time highs. Obviously, there was damage done in the first quarter when the news initially was absorbed by the market, but the comeback has been that and then some in terms of momentum returning to the market. So I guess it's a matter of how forward-looking can the market be? Can we, regardless of the exact, sort of end to the pandemic as we know it, can we just look past that, right? And it seems to be telling us that we can, but I think there's really no way to know for sure. I think if we can say, okay, in June, we're all going to have access to this vaccine, let's say. So that would naturally be something to kind of like create a light at the end of the tunnel. Okay. And indeed, that's something that could fuel the market. Whether or not we have any additional shutdowns or the so-called dark winter, I think as long as the sentiment can be preserved, that we have sort of that light at the end of the tunnel, maybe it is priced in. Yeah.
Okay. Mickey, you covered in my introduction that I'm an ops guy, not an investment guy. So I don't have the knowledge that the rest of the folks on the call have about this. But as I sit around and listen to my partners talk about what they expect in the market, it really, I think we saw a little glimpse of that today. I think Michael touched on the surprise on the upside of the efficacy of the vaccine. The 90% efficacy rate was, I think, probably really good news that was not fully expected by the market. That said, I think the market did expect that we would have a vaccine, and that's been priced in for a while. When it actually arrives, how long it takes to produce, I think, as I understand it, that they're already working on production of these things ahead of the actual approval. So there's still validation and still some further testing that's going to be required to get us there, but production is going to start in advance. And so hopefully it gets here in the spring. But what you saw today was that COVID winners and COVID losers. So when we had that recovery off the bottom, things that made life better or easier in this COVID environment and remote world that we live in, the Zooms of the world and the technology companies and the food to go and all the things that really infrastructure or industrial supply chain, those kinds of things really fared very well from March until now. But there were a lot of companies that didn't, and travel and oil and things that were really left behind. And I think you saw some of that repricing in today on the hope that we're starting to see that we'll solve this pandemic at some point, that it will sooner rather than later. We'll start to return to a normal economy. People will start moving around more, traveling more, and you'll see travel stocks and cruise ships and oil stocks start to recover. And that doesn't mean that the COVID winners are going to go down necessarily. They did a little bit today, but you can have one where they're impacted slightly, but the others are rewarded greatly going forward. And that's just one potential scenario.
Right.
I think that's a good point. I think until vaccines are really sufficient enough to yield, herd immunity, we're not going to have activity levels normalizing, right? I think Pfizer said they could do 1.3 billion for next year. And keep in mind, there's 10 other companies that are in trial 3 phase, trials right now. And I think we are expecting news out of, Moderna and AstraZeneca in the coming weeks as well. So I think the market, to Katie's point, loves to see the light at the end of the tunnel. Everyone is pricing in for return to that normal activity, but it's probably, a good ways off from where we sit now.
As a psychologist, what I find interesting is what we're really talking about is aggregate human behavior. And what's been fascinating to me during this whole situation is that it's not so much what governments do, is what people are willing to do, right? So whether or not there's any shutdowns, it's really whether people are willing to go to the movie theaters, are they willing to go to the restaurant, right? So in some ways, it's what will it take for people to feel comfortable doing these activities, not what will it be potentially objectively allowable or safe to do. So I think that's really interesting. I don't want to leave the election just yet. I want to try this one more time. So we heard a lot of the policies that you think we're going to get based on a split government and a Biden-Harris administration. If you would be so bold, or at least be so brave as to tell me, what would you like to see? Not what you think we're going to get. What kind of policies do you think would be most effective or most useful right now from a new administration?
I'm happy to jump in. I would like to see more on climate and ESG. Now, I don't think that there's the appetite from, a Republican Senate on that front, but I do think that, that's critically important to our future. And I know that was part of the agenda. Who knows how that will play out? Again, I think we could see something done on the Paris Accord, and Biden has talked about that straight away. But, I do think that, if I had a wish list, that would certainly be high up there.
So speaking of climate, is it fair to say that there are some industries that are already being affected and are being priced into the climate change? So whether it be insurance companies and some real estate, is that true? Katie, you're a technical analyst. I don't know if you can tell that from your analysis, but are climate effects already impacting some industries?
I would guess so. I mean, I think that would require more fundamental knowledge of these companies, but we've certainly seen rotation into the clean energy space. So in terms of the public equities that are trading, there's 2 ETFs that I think it's TAN, so TAN, which is cute. And then there's maybe PBW is the other one that are actively traded. And these have really garnered a lot of interest recently. So you're not alone, Kathleen, in your desires to see more of that. And the trend is there. It's not just about COVID. It's not just about the election, but there's definitely been some rotation into that space.
Well, as it relates to the markets, it's an interesting because there are certain themes that people are interested in investing in because they believe they are the future. And some of them are more easily investable than others, from my perspective. If you believe in 5G, you could easily think of all these great companies that are going to benefit from it, or digitization of transactions and currency, and you can think of all these amazing companies. When it comes to green energy, most of the companies that are public make no money. And so the interesting kind of thing that's going on right now is people searching for a way to invest in something like that without being speculative, and it's not easy. I mean, I can name the only companies that are substantial and make a profit and count them on one hand. On the other hand, I increasingly hear from our investors, the people who have money at our firm, that they don't want us sometimes to own oil or energy or coal or whatever. It's now part of the conversation you have about cigarette stocks, and that's kind of a new development. The fact that that fossil fuels are suddenly an ethical issue. And so it's there's a debate about whether the energy sector, which is the worst performing sector by a mile for recent history, can recover, or if it's somewhat uninvestable for a larger and larger chunk of money. But even if you wanted to take the other side, the green energy side, it's hard to put real money to work there as a public market investor.
I'm curious, Kathleen, is your perspective also on terms of long-term risk and medium-term risk that ESG allows you to see some of this risk? And also, I saw recently some analysis that suggests that if you take the externalities that are not priced into a company, so for example, the cost of cleaning up something or pollution or this and that, and you actually brought it onto the balance sheet of a company, few of them would actually make any money. I don't know what you think about that perspective, but is that what you're suggesting?
Yeah, I mean, I think it's very front and center sitting here in Europe, because European regulators have moved fastest and furthest to try and regulate sustainable finance. And so we're in the middle of that right now, and there's regulations coming into play around things like a sustainable finance framework, how you disclose, how you report, how you calculate, what is the taxonomy. So all of this is coming to both the issuance market by companies that are issuing, as well as the investors that are buying those securities. And so I think this is really playing out real time in Europe. And this is, I think it's just going to be the future. You're going to analyze investments based on risk, return, and sustainability for all the reasons that you said, Mickey. So I think that this is the start of that, where it will be just another factor for us to all consider.
Okay. All right, so
Vicky, yeah, I don't know if this is a policy that I would like to see or not like to see, but I'm hopeful that with whatever form of government we end up at the end of this, whether it is gridlock or whether we have a complete democratic Congress and presidency, that somehow or another we're able to avoid the capital gains being taxed at ordinary income. I think with so much of the stock being held in the hands of wealthy individuals and those who are going to bear the brunt of most of this, I think it would put pressure on the stock market to see capital gains be elevated to ordinary income tax rates, which has been proposed by Biden. But on the flip side, I think if there's a way to thread the needle on our foreign trade and our relations abroad with that, I think there's some repair that can be done post-Trump with some of those countries, but we want to get things where we have better relationships, but we also want to make sure that they're fair and equitable. And having that balance, I think, is going to be a heavy lift. But if the new administration can pull that off, I think that would be a policy I think we'd all benefit from.
All right. Thank you. So speaking of government and government intervention, we saw when this all got started, massive amounts of government intervention to try to support the economy, whether it was direct payments to individuals and families, support of businesses, and all of that cost a bunch of money. Governments were printing tons of money. So people who signed up for this program, and I wanted to ask as well, have concerns or questions around the debt levels. So let's talk about that for a minute. Are you concerned about the debt levels that are being incurred both by the US and countries, other countries? And then we can talk a little bit better about who's better positioned to deal with that debt. So just broadly speaking, first of all, should we be concerned about government debt right now?
You would be, I think, hard pressed to find someone to say that they're not at least concerned in the back of their mind. You know, with the idea that at some point it catches up to you. From a practical standpoint, if you look at government expenditures, interest on our debt is about 8% of what the government spends every year on interest, and that number hasn't changed for over 50 years. It you know, kind of moves around a bit, but right now we're not out of whack. And so it's not crowding out other spending. People are still willing to lend to the US government at less than 1% on their money, which tells you there's no inkling of concern about the creditworthiness of the nation. So ultimately, if you take it a step further, the big question, I guess, then becomes inflation, because the only thing that raises rates is inflation. And so if we do end up with a lot of inflation and the Fed has to raise rates, and suddenly now you have all this debt and it has to be repriced at a higher interest rate, then you got a problem. And so that, I mean, it's something that we could have probably hours of calls on just that, you know, on whether there will or won't be inflation. But the people who seem to have a pulse on that think at the very minimum, there's no inkling of inflation for at least the next couple of years. And we'll see. You know, I feel like I could make a strong argument for inflation and a strong argument against inflation. And both of them sound convincing to me. So I don't know.
Yeah,
Katie, no, go ahead, Kathleen.
I was going to say, I think that the current backdrop points to, you know, kind of limited prospects of inflation anytime soon. To echo what Michael said, if anything, you know, I think we're facing more disinflation with the pandemic accelerating things that are more deflationary, like automation, technology advancements, e-commerce, and youth unemployment. Sadly, those things tend to be disinflationary. And I also, you know, when you look at kind of debt dynamics, we don't think that there's a major concern now in the advanced economies, because you've got historically high debt alongside historically low interest rates. So you get historically average cost of servicing that debt. So to back up what Michael said, you know, we're kind of in this, you know, area where things probably won't change from the sense of the cost of servicing that debt.
But high leverage brings high risk, right? As you were saying, Michael, any change in that interest rate will have a huge exponential effect that will ripple through the economy. So there's very little margin of error. Is that fair to say? So
And-
that's,
and I think a lot of it will have to do, you know, how do these central banks react once you get past this pandemic, right? Once the vaccine and herd immunity has arrived and markets normalize a little bit, do they remain, does the monetary policy remain at ease? And if easy money continues out there, you know, I think a lot of folks believe that modern monetary theory will lead to inflation. So I think we have a little ways to go before that, but we'll probably test that on the backside of the pandemic.
Depending on where employment rates are. I'd say
Okay.
that's the big thing that central banks will watch.
so let me talk about another kind of debt. Then I want to go back to the international question. What about corporate debt? Are there concerns about, you know, there was a lot of support from the government to certain industries. And we see, for example, the airline industry, Southwest Airlines, other airlines that are starting to lay off some folks. So what about some corporations that are really saddled with debt? Do we have any concerns there?
I think when you've got central banks buying corporate debt and really easy monetary policy, when you looked at where you want to be in fixed income, we sort of like corporate debt here because of that reason. You've got QE, the Bank of England just expanded their QE program last week. You've got, you know, the EU, you know, I think in the short term, it looks like an attractive place to be. But I don't know if others have any different thoughts.
It looks, for, you know, to me, it feels like there is almost no, it's hard to fail right now. The Fed has opened the spigots to the point where no matter, you know, it's really, really hard. I mean, you have to be so, I mean, if you have to be the New York subway system with, you know, 50 to 70% reduction in ridership and a hole that you could, you know, drive a truck through, and yet still people are willing to lend to them at rates that, you know, you would think don't make any sense. And so the bigger issue, I think, might be for small businesses who don't have access to the same facilities. And we'll see how that plays out. You know, the PPP like loans, they really were handouts, was temporary and one time in nature. And, you know, see if the vaccine works its magic quickly enough for these companies just to survive. But that's where, you know, when you say, are you worried about corporate balance sheets? The public companies, no. In fact, they're oftentimes now refinancing debt at cheaper rates they've ever gotten. It's the small businesses that may not get a line anymore.
Well, and since small businesses make up a huge percentage of the economy, are there some ripple effects there? And then you haven't even talked about local governments, state governments, and where their balance sheets are and how their revenue outlook looks. Is that something that we see coming down the line as well that we should be concerned about?
Well, perversely, it supports the public markets. I mean, where you have, think of all the restaurants that are going out of business and right now, and if they're even able to survive, their business is down 20, 30, 50%, whatever it might be. And yet, you know, McDonald's same store sales is positive year on year, you know, and that's emblematic of what you're seeing in other industries as well. So, you know, that's part of the reason I think why the market's doing well. I mean, there are a lot of other reasons, complicated, but part reason the market's doing well, even if, you know, Main Street in theory is not, because this is not a representation of the entire economy. It's the large companies who happen to have resources, happen to have access to the Fed, happen to have all sorts of things that the small companies don't. So, you know, will some of the small companies go out of business? Yes. Is that bad? Yes. Will it, you know, hurt the economy? I don't know. It may just be a share shift, and then it becomes a more philosophical issue.
Let me come back to the international question. Are there some countries that are better poised than others? And somebody asked on the chat here on tariffs as well, and throw that into the mix. What are your thoughts on when we look at the global outlook? Who's better poised than others?
I'm happy to lead on that one if you like, Mickey. I think when you look at what drives countries' recoveries, and let's leave like the vaccine aside for now, it's really the spread of the disease or the spread of the virus. It's the policy actions that were taken by their governments or their central banks, and it's the structure of the economy. So I'd say on those metrics alone, China is clearly pacing ahead of the rest of the world. They've had a more of a V-shaped recovery. They've controlled the spread of their virus since August. Their policy actions have been very targeted at parts of their economy, like the construction sector, real estate sector. And it's a huge export-oriented economy. So it's benefited from all this demand from other parts of the world for its exports, and its medical supplies. And we've seen this also play out in other Asian economies. So it's also, I think, the only economy that will have positive GDP growth in 2020, according to our forecast. So Europe and the US, much more of a K-shaped recovery, which means, you know, K symbolizing divergence, which is resulting in incomplete recovery so far. So you've got the sectoral divergence. You've got, you know, kind of retail sales and manufacturing doing well and rebounding rapidly. And you've got the services sector, which is travel, leisure, hospitality, really lagging. We've seen labor market divergence where you've got, you know, more women, minorities, and lower income workers are in the service sector. More, you know, those folks are out of work. As Michael just said, you know, small businesses are suffering and big business or public companies are not. And then you've got virus, you know, experience divergence. You've got second waves in the US. You've got second waves in Europe, lockdowns in Europe. I'm sitting here, which we've gone into lockdown as of last week. So that restricts activity. The good news is that lockdowns aren't as restrictive this time around as they were last time. So there's some sectors of the economy staying open here, like construction, manufacturing, education. And I think people learn lessons from the first lockdown. So we know more about what to expect. Certain companies have digitized their business more, so they'll be able to take advantage of that now. And we see that economies can actually bounce back quite quickly when revenge spending happens. And, there's some early indications from countries like Belgium and Ireland that went into lockdown earlier in Europe. Their cases have started to come down. So our hope is that this does just last a month or 5 weeks and that Christmas isn't entirely canceled in Europe, but we'll wait and see how it plays out.
Did you say revenge spending?
Revenge spending, yeah, we certainly saw that in China when the lockdowns were lifted. We saw that in the U.S. and Europe as well.
Yeah, great term. All right, so let's talk about investment strategy. Katie, what are you advising your clients? What are you asset classes, industries? What does your analysis suggest people
Yeah,
should?
I mean, first I'll address the international markets and following with Kathleen's comments there.
Thank you.
I mean, China, it's a long-term turnaround. We had a big breakout earlier this year from, we call a triangle formation. So a triangle on a chart shows that this neutral phase with a tug of war between buyers and sellers. And we came out of that in the Chinese benchmarks very decisively this year, now consolidating with the US tape, but really very promising from both an absolute and relative perspective versus US. So I think there's a lot of promise, technically speaking, for China. And I'd expand that to emerging markets. A lot of the emerging market benchmarks have something like 40% exposure to China anyhow. But with the weakness that we've seen in the US dollar, there's been some meaningful rotation and certainly a loss of downside momentum in relative terms behind those emerging markets. And it's a little bit too early to call it a lasting reversal versus the US, but definitely a renewed comfort with going back to these emerging markets as a function and part of that weakening dollar. If we see the dollar break down further, then of course that could become more pronounced. The way I'm thinking about developed global, especially Europe, is as like a value trade. So I think if value versus growth starts working in the US, then we'll see European benchmarks do a little bit better. The charts there set up really similarly, and whether that makes a lot of sense or not fundamentally, I'm not so sure. But that value setup, I think, holds some promise, certainly more so than it did before. We're looking at things like ratios of value to growth benchmarks here domestically. And those ratios have been in downtrends that were very, very sort of uninterrupted. But just in the past few weeks with the consolidation that we've definitely seen there a loss of downside momentum in relative terms as well. So I think it's a little bit too early to suggest that we're going to get these big breakouts and decisive reversals, value versus growth, or developed global versus US. But there are some early indications of at least a renewed comfort. So maybe more of an inline type of situation that suggests that people are more comfortable with those kind of opportunities, even if it is a sort of a divergent recovery that we're definitely seeing. I think today's action, not to get too short term on it, was pretty interesting and informational in a way with how the market reacted to positive news, which we were all hungry for as it pertains to the coronavirus. The positive news of that vaccine development really impacted certain segments of the market very positively, and then others quite negatively. And I think folks would be surprised, even though I think the S&P was up at one point intraday, 3.9%, so almost 4%. There were some stocks that were down the same today. So there was a major divergence in terms of the comfort level with folks sort of pursuing those stay-at-home stocks, the ones that had been run up because of the coronavirus. And I think that kind of dispersion is really interesting and something that could persist. And it's also something that could occur to the benefit of stocks outside of the momentum names. So by momentum names, I mean the software, the cloud computing stocks, and the home builders that got run up. A lot of these names were beneficiaries of the environment. And now perhaps we'll see a growing comfort with, material stocks and financial stocks as treasury yields flirt with 1%. Industrials have really kind of reasserted themselves. So I think that spreading out, even from large caps to small caps, could be what helps the market still forge higher, but with a different set of leadership. It's not, I think, going to be all about the FANG plus M, so Facebook, Apple, Amazon, Netflix, Google, Microsoft, those names that we become, I guess, relying upon for upside leadership. I think it'll be less important that those are the sources of leadership with the spreading out that today would have indicated as a possibility as we get more and more positive news from the healthcare sector as it pertains to the virus. So we're watching the very short-term action really closely because it does have implications from a technical perspective. We tend to give more weight to breakouts and breakdowns than just about anything else. And a breakout is when a security clears a level that it previously had met sellers at. So it's just kind of relieving a chart of selling pressure. And that's what we have the potential to have seen this week, but we won't really know for a couple of days because of the week closed today for one. We always want to see breakouts confirmed on a couple of closes above a level. So we did not get that today. We do expect that perhaps we will see a lot of that by the end of this week, and that would then suggest that we get more aggressively long U.S. equities, with that light at the end of the tunnel in mind, and perhaps see expansion from that sort of large cap growth segment that we'd all become so comfortable with. So that's the recommendation that's holding in the balance of this week's action. But certainly up until this point, we'd seen a loss of momentum. A little bit of a sort of an increase in volatility. You would see that in measures like the volatility index, and a little bit more skittishness that does create a growing discomfort. But I think we can get out of it with these breakouts.
Oh, thank you. Michael, how do you see it? Do you?
Well, you asked about asset classes, so
Right.
I'll tell you one. To me, absolutely, I prefer stocks to bonds. I can't for the life of me explain bond valuations right now. Let alone the trillions of negative yielding bonds, which which is a whole nother conversation. When, if you think Microsoft or Apple are expensive at 25 times earnings or 30 times earnings, think about what bonds are trading at. If you've got a muni bond with a 1.5% interest rate, you take the inverse of that, it means it's trading at 70 times. There's no cash flow stream in my mind it's worth 70 times. A treasury is at, with the current rates, over 100 times the cash flows. And so I think bonds are wildly overvalued fundamentally. It doesn't mean I have any idea what's going to happen next month or next year, but fundamentally, I think they're overvalued. And I think if in fact we ever get inflation, this idea that bonds are safe will suddenly feel a lot less of a truism. Developed markets over emerging markets. I think you asked about earlier about how long it will take for the vaccine to be distributed, and the answer is vastly different for the US and Europe and China and Japan than it is for Africa and India and Latin America in some areas. They don't have the infrastructure to handle it, let alone the ability to secure what they need. They don't have the refrigeration and they don't have the medical system. And so I think it'll be a harder couple of years for emerging markets than developed markets. And then within, developed market stocks, I've always felt like growth versus value is kind of a false choice. I feel like there are opportunities in both areas, depending where you look. But to me, the most obvious area of opportunity as an investor are COVID affected stocks, where people don't have the imagination to think that we'll go back to normal. And so there are everything from, the cruise lines and the airlines are, still down 50%, even though they went up a bunch today. Boeing was a $450 stock. It's now 180. And so, you could find these pockets, these companies that are meaningfully affected today, but when we get back to normal, there's a lot more upside versus chasing some of the high flyers, like Katie mentioned, that everyone wants to own because they're fun to talk about at cocktail parties and they've gone up so much recently and no one's had an experience other than making money in them. But those are some of the things I think about.
Excellent. Thank you both. Oh, that's amazing. Couple of questions coming in from the audience, and it's related to what you just said, and I'm curious all of you all to comment on this. There's a question around our behavior. I mentioned that this is all, the economy is the sum total of individual behaviors, right? It's what we do and the economic activity we engage in. What of our behavioral changes do you anticipate will be long lasting versus short term? I mean, you just mentioned, if you think we get back to cruising, and I've done, my family and I've cruised, and we've gone on many, many cruises. My wife keeps saying, "Hey, we need to go back on a cruise." And I say, I'm not getting in a cruise ship anytime soon. It's going to take a lot for me to get back on one. But do you have any thoughts on what will be more lasting and what won't be? I mean, I know that's a crystal ball kind of question, but I'm just curious if you have any opinions on that.
Oh, I can start. Buffet lines are dead. No, I'm just kidding. I would say, optimistically thinking, I do think that the experiment of proving more flexible working arrangements, I don't think that that's going to completely go away. And I think that's driven by the technology, and we've proved that it can be done. But I also think it's driven by the preferences of the younger generations, millennials, Gen Z. There's generational shifts happening, whether it's as it plays out in politics, as it plays out in consumption. There's disruptions, and I think that will also extend to kind of what preferences are when it comes to work and flexibility there. And now that we've proven that we have the technology to support that, and I do think there are some companies that have been very have made plans to divest real estate or shrinking their footprint. Those aren't things that you do one year and you reverse it the net. Like, I think those are longer term trends. So that's maybe one I can point to, but I'm sure that there's others on the panel that have thoughts around that.
I mean, I think that companies now are in a better position to trust their employees to work from home. So I think that was sort of a psychological issue for some companies. Even my own, you want to sit in the room with someone to trust them. But now we were forced into this situation. And I think companies and managers are realizing, well, gosh, you know what, we're still getting, just as much done, if not more. The effectiveness of using a format like we are right now with the Zoom videos, it really is, I think, in a way, increasing productivity in that folks have more time, less time for business travel, more time spent being productive at their desk, and also able to interact in a way that now folks are incredibly comfortable. Folks that before were uncomfortable checking their email, I've noticed now can figure out the whole Zoom thing. So I think that growing comfort with this format has been really well received by managers.
Excellent. To your point, just real quick, we're now hiring people that we've never met in person, right? I mean, think about that. Could we have ever conceived of that? And we've certainly done it. I'm sure all of your companies have done it. You're working people, integrated people into your teams that you've never met. David, I think you were going to say something.
Well, I was just going to say, I'm not sure what's going to stick around and last beyond all of this, but I think everything's up for consideration, right? I think that there are a lot of companies that are located in urban centers and cities, high density cities, that having their employees return and work their way up 40 floors in an office tower, that's going to be a longer term decision than just today or tomorrow. And I think companies are going to look at moving, out to more rural areas or suburbs to have their employees work, if they're going to work in a building at all. I think certain jobs, whether it's call centers or things that can really be effectively transitioned, the technology is there to have folks work from home. I think companies will really seriously consider that. Things like the companies that Michael was touching on a moment ago. I don't think Zoom's going away, right? I think there'll be continued competitors for this type of technology, and their stock certainly took a little bit of a hit today. But we've introduced it into the way that we operate, and I think it will become maybe not as, we won't rely on it as much as we do today, but I think it will become a way of doing business. And the same thing with sort of your free time. I think Peloton took a little bit of a hit today, but I think the idea that that I can don't have to belong to a gym, and I can exercise at home, and I've got some really good ways to do so. And again, more entrance into that market will probably follow. I think there's just going to be some shifts that will take place. And I think probably one of the larger ones that we really haven't thought about is higher ed in your world, Mickey. I think there are a lot of universities and colleges that are going to have a hard time figuring out how to deliver what they deliver today, because I think a lot of families are going to reassess the value of the college experience on campus versus what they've seen for the last call it 6 months or 9 months. And so the well-established universities like the University of Richmond, where there really is a value proposition, they're going to be just fine. But there's a lot of schools that are not University of Richmond that I think are going to really have to either adapt and change the model on how they deliver education, or it's going to be a real struggle financially for them. So I think there's a lot that it's going to be time will tell, more so than, we figured it out and we're going to move forward with this new knowledge.
I think that's
I'll take for a moment, just for the sake of it, I'll take an alternate point of view. I think it's all going to go away. I think we're all going to go back to the way we were. It will take some time, but I think we'll all go back to prior habits, and humans are social animals. And I think there's some technologies that have been accelerated, but we're already in place and starting to gain some traction as is, whether it be Amazon for online shopping, or cloud computing, or using Venmo instead of cash, or whatever these are things that were already being invented and just got accelerated. But if you ask me, my best guess, because you're asking us to predict the future, if my best guess is, if there's one residual impact, the people that grew up in the Depression, all worried about money for the rest of their lives, I wouldn't be surprised if you have a generation of people that are worried about germs in a way that they weren't before. I don't know how many years will go by before, when you meet someone new, you're going to shake their hand without feeling awkward, or at all. I mean, I think there's going to be so that, but I think most everything else will go back, and it's just a matter of time.
Well, the beauty is we have this recorded, so 10 years from now, we can go back and see. That will be great. All right, I have to ask, because somebody put it on the chat here, Bitcoin or cryptocurrencies, what is your take on that? So they ask specifically, how do you view the role of Bitcoin going forward? Overvalued, undervalued, substitute for gold? What is your take on cryptocurrencies?
I mean, I can take that. One of the best ways to analyze cryptos, I think, is using the charts. So, and obviously there's momentum there. It has been treated as, I guess, a risk asset, if you will. But it also, up until very recently, had maintained a correlation to gold prices. So it was being treated as that sort of alternative to gold, another currency, if you will, and it had this nice lack of a correlation to the equity market that makes it somewhat compelling and attractive. We also saw a major breakout, so a breakout above a previous high on the chart. And it puts the next and final resistance at the ultimate high, I want to say 19,000 something, which sounds crazy now. It sounded even crazier when we got the breakout and we're flirting with 10,000. Now I see it's just above 15,000. So really, really wild momentum there. And yet, because the uptrend has been interrupted by these consolidation phases, it's prevented it from becoming what we call sort of unsustainably steep. When you see these really sharp up moves, they kind of look like flagpoles on the charts. It doesn't really have that feel to it. So it's an area that has momentum. I've always been sort of a believer, without really understanding the technology to a great degree, that some exposure to it as an asset class makes sense, in the same way that I think folks should have a small sleeve of their portfolio exposed to precious metals, given a non-correlation or a lack of to US equities, that it makes sense to have a very small position, maybe 0.5%, 1%, whatever it may be, to cryptos as almost a call option on the asset class, is something that could be a massive winner if the institutional set really gets involved. And evidently it seems to be certainly capturing some momentum, and perhaps it is somewhat institutionally driven. So.
Any other thoughts on cryptos? I'm old fashioned, right? I can't take a piece of crypto and put it in my safe, right? And I can't chop a little bit of it and give it to someone. So I can't see how it can be correlated to gold, but that's a whole nother issue. All right, we're running out of time. We got just a few minutes here, and I'm sure we have quite a few students. And by the way, the growth versus value questions, I'm sure the Smith students out there are wanting to know the answer to that. So that's probably where that came from. What would you say to our students right now in terms of what they should be preparing for? What do they expect coming out into the job market? What if they want to have a career in finance? How should they be preparing differently? So in the last sort of 4 minutes that we have, can we bat around that idea? Advice to our students. Anybody?
My first advice is don't put your money in Bitcoin. At least if you want to gamble, go to a casino. You'll have a better night.
So you're old fashioned like me. Huh? What else? Any thoughts on
my advice to Richmond students pretty consistently over the years is that, you know, we as Richmond Spiders, we don't necessarily get recruited in the same way that people who came from Harvard or Wharton get recruited. And so we just have to sometimes work a little harder to get our foot in the door. And I find, you know, pretty consistently now at more than one firm that, you know, once you get into the game on Wall Street, if that's what you want to do for a living, the cream rises to the top. It's really a meritocracy. And if you have skills and you're able to make money and make money for your firm and do all this, I mean, you're going to succeed. So, you know, it might take a little extra effort, but, you know, network as hard as you can, get yourself that first job somewhere, somehow. It doesn't even have to be in New York. It doesn't have to be in the area you want, but if you get yourself in the game, you know, you'll find your way.
Well, you know, what's interesting, that's been an interesting shift because of the situation we're in. The barriers to recruiting have been dropped because of all virtual recruiting. So we actually are seeing firms interviewing our students just as easily as any other place. So they're no longer limited to, oh, I want to go to a large school because I can call through a large number of kids and get, 10, 15, 20 of them. So those barriers have gone away. So I think that's been one benefit for our Richmond Spiders. So any other thoughts, last minute advice as we wrap up?
I would just say that I'm always so impressed by, our Richmond students when you do engage them. They're, you meet them, they're on the phone, they're interviewing, you're doing a recruiting event. I mean, they really do, to Michael's point, rise to the top, and the cream does rise to the top. So I would say, have that confidence and just know how well positioned you are, versus some other students out there from other schools, and have that confidence and really lean into that. And I love the fact, Mickey, that you say that the current environment that we're in, has created more of a level playing field. Definitely take advantage of that.
Absolutely. David, Katie, any thoughts?
Mickey, I shared with you last week or the week before, we had a couple projects we need some help with, and we turned to University of Richmond, and we had 70 resumes, probably more than we would have had because of COVID, and folks just trying to fill the gaps they might have otherwise had through internships. They were unbelievably impressive on paper, and interviewed 10 virtually, of course. We could have hired any of those 10. They were incredibly impressive. We hired 2 of them, and they are living up to what we expected. They're wonderful. And the only advice I would just offer is, and I think we said this on the last call, is, in this environment, just demonstrate your resiliency and what you did to sort of get through what is a little bit of an altered environment for college students coming out, whether it's for an internship or post or once you graduate, and just show how you dealt with it in a way. It's maybe less about the normal criteria and a little bit more about who you are and how you got through this.
Excellent.
And I just add, follow your passion. I had a fantastic intern from University of Richmond. He may be on the call tonight. Hi, Ray, if you're there. Listen, if you follow your passion, you're going to be good at what you do. So he's decided to go to sports marketing, not technical analysis. That's okay. If that's where your passion is, I really think that that's where you exceed. And students have the luxury of a little time and leeway, especially even seniors at this stage, to think about what they really want to do. When I talk to someone and go through an interview, what I get excited about is what they get excited about. And I think about trying to mold a position to where I see them light up. So exhibiting that passion is important, but really to make sure that you're staying true to yourself and what you want to do. I think that's key to not only your success, but also probably long-term happiness.
Thank you. And I would agree, when we're hiring faculty, we want people who are passionate about our students, passionate about teaching and our scholarship and making a difference in our students' lives. So I totally agree with that. All right. So as we say goodbye, there was one question here. Is there going to be a pullback? Yes or no?
There always is.
That's right. It's just how long will it take till it comes, right? Yes, eventually, right? Excellent. Well, Kathleen, Michael, David, Katie, thank you so much for spending the time with us. I hope that the audience, we had over 100, we're still above 80, so people stuck around. I think they really learned a lot from your discussion. I just want to encourage all of you out there to check out the Richmond Alumni and the Robbins School of Business Facebook and Instagram page. We're always putting up stories about things that our students are up to, faculty, staff, and alumni, as we have here, some great alumni. And stay up to date to what's coming next. We have the Robbins Executive Speaker Series. Mark Lopez from the Pew Research Center will be here next week. So we're looking forward to that. And I hope to see you all soon. Hope to see you all on campus when we're allowed to do that. In the meantime, stay safe, healthy, and go Spiders. Thanks, y'all.